This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
On this week's show, it's Santa and Krampus, and we end the year with a focus on two juxtaposed forecasts for 2024 from two large Wall Street firms. You'll have to decide which one to believe in. Welcome to the Wise Investor Show. I'm Chase Hinderstein. Last show of the year, and weeks after the night that brought Krampus's antics on to punish those who have been behaving badly this year, I'm now paying homage to him after I took a recent trip to Central Europe. And I'm going to reflect on those that are behaving badly and forgetting their discipline in the markets right now, which is kind of what the last few weeks have felt like. These are the very same people, in some cases, who lost all hope in the sell-offs that we saw in September and October, and they thought that the markets then were only just beginning to price in what these folks had as their kind of version of a political Armageddon, and depending on which person you asked, it got reflected in various ways. And they've now gone and forgotten those dark days of a few weeks ago, and many points ago in the market, and they're now ready to let the fear of missing out drive their allocation decisions. And they're sold that now these are really just the early innings of some kind of rally that just really cannot be stopped. They just flip-flop from one side to the other. And you know what? It can be hard to come out this time of year, tremendous rally in the markets, and it's challenging to be a pessimist when we're now breaking the new highs in the markets and we're myopically focused on the prospects for interest rate cuts around the corner. But remember how you felt on Halloween when the market was at the tail end of this recent mini correction, when so many were then filled with doom and gloom, and recognize how little really has changed since then, how fundamentally actually some things have gotten worse, but also, the asset prices are substantially higher right now, although we do have some reasons. You got to take some balance in. I am not truly a pessimist. There are reasons that the market has rallied, and there's some legitimacy to it. But really what I'm saying is be cautious. We're seeing volatility pick up, and there's no telling what's occurred between when I've recorded this and when you hear it. Because I have to get this done, unfortunately, this week pretty early. Due to some holiday production limitations out there, I'll say. So it's going to be a little shorter than usual. The first segment's going to be particularly short because I don't want the market to blow up after I publish this and it be completely irrelevant. But we'll get to something on the second half. I could have called this podcast this week perhaps Who Should You Trust? Because really the focus is I'm going to return to a Goldman Sachs report with their forecast for next year. And I kind of hit on that a few weeks ago. But I'm going to contrast that with the JP Morgan 2024 forecast. And the two reports are so completely opposed to each other. It's as if they were written respectively by Jane Curtin and Dan Aykroyd. First, though, a wee bit of data. As these are important points, I know by the time you hear it, it's going to be over a week old, but we got the consumer confidence numbers, and it's a key data point right now, I think. And the numbers blew the doors off the expectations. The reading was over 110, with the estimates, according to FactSet, were for 104, and versus a prior reading of 101. So the consumer who may be running short on cash, which I'm going to get to in that second half, but they're not running short on credit yet, they're feeling pretty good about Christmas, and they're spending away right now, which isn't surprising because we also got the continuing jobless claims numbers and new unemployment claims, and they both remained low and lower also than the FactSet forecasts. Of course, a lot was triggered by the Fed Reserve's meeting when Powell came out and he seemed to indicate that they're willing to cut rates or expectations, depending on how you read it to what he said. They think they're going to cut interest rates 3 times next year. Now, I guess he could also raise them before then, but anyway, the market thinks they're going to cut interest rates 3 times next year, despite, since then, a parade of federal governors coming out on every bit of financial media walking back that expectation. But the market now assumes that cuts are on the way, and they're pricing in one for the first quarter next year, so really within the next 3 months. Yields have come off their recent peaks, but they're still only really back to where they were in August. The 30-year conforming mortgage, which economically speaking right now might be one of the most important rates to focus on, which isn't just based upon with the short-term overnight interest rates, and it's not just linked to the 10-year Treasury, but there's a spread to that that's important, and that spread can and maybe hopefully will contract. But the average 30-year conforming loan right now is 7.18%, according to the Wall Street Journal. And that's down from a little over 8%, 8.05 it was at the end of October. So 7.18, still pretty high, but off the recent peaks. And we also got new home sales and new building permits numbers that both continue to exceed expectations. Now, of course, 2023 was the year of the so-called Magnificent Seven. And according to a Wall Street Journal article, it was, quote, "It's the Magnificent Seven's market. The other stocks are just living in it," end quote. Well, the Magnificent Seven finished 2022 last year, collectively, those 7 names, down 40%. They lost $4.7 trillion in combined value last year, whereas all the other stocks, 493 stocks in the S&P 500, dropped 12%. However, those 7 names are now combining to be 5% higher than when the market initially made its previous all-time high at the start of 22, while the other big bunch of S&P 500 stocks are still down 1.5% from that January 2022 high. The traditional S&P 500 is, though, now weighted. It's 30% of the index is in those 7 names, which are obviously very highly correlated with each other, albeit not in the exact same business, in similar businesses and trading in a similar fashion. And it's an unprecedented weighting for so few names in the index. And there are reasons, both macro and specific to their businesses, that these names have continued to shine. But when we talk about how much good is already priced in for the future, how much of 2024's outcomes are already reflected in the price, it's really these guys that are driving that valuation challenge. The rest of the market, excluding them, is at a discount to where it normally trades historically. You know, these may be and often are businesses to own judiciously, though. So first, the kind of notion to end this year and think about next year, just be aware of how much exposure you're carrying to any single one of them or them in total as a group. Maybe you're one of those indexers out there and you have all your money in that one index. Well, then 30% of your money is in those 7 names. So let's, as always, use this time of year to recalibrate our risk exposure. The rally is a great time to do that. And think about, all right, if, not when, but if things were to sour, will I regret having too much hubris when things felt good like they do right now? All right, I am going to head into the break a bit early, but like I said, it's a redacted show to end the year, but I'm going to return with the stark contrast between those 2 prominent firms' outlook for next year. As a preview, the opening salvo here from the more pessimistic of the two is J.P. Morgan, and their report kicks off as follows, quote, "We started out 2023 with low expectations for global growth and elevated fears of recession, but China's reopening, large fiscal stimulus in the U.S. and Europe, and residual strength of U.S. consumers stabilized growth. Various themes also sparked market optimism. The examples they give are AI, luxury goods, weight loss drugs, expectations of Fed cuts, cryptocurrency, et cetera. Anyway, going on, resulting in risk markets delivering broadly positive performance. As we approach 2024, we, meaning J.P. Morgan, I'm still quoting here, expect both inflation data and economic data to soften as the tailwinds for growth and risk markets are fading. Overall, we are cautious on the performance of risky assets and the broader macro outlook for the next 12 months due to building monetary headwinds, geopolitical risks, and expensive asset valuations." End quote. We'll be back with more of that joy in a few minutes.
Stocks and bonds are volatile, but your financial plan doesn't have to be. Have you sat down to map out an investment plan you can trust when emotions and headlines stir panic? I'm Simon Hamilton with The Wise Investor Show. Every week we discuss the latest financial trends and what investors need to know. To learn more about how to stay grounded and to become a better informed, wise investor, listen to The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. Okay, so we start off, JP Morgan is scared of geopolitical risks. Who isn't? Building monetary headwinds. Well, I'm not so sure about that. We might be getting monetary tailwinds. Even they believe in rate cuts, so we'll get to what they believe there. And expensive asset valuations. Well, as I said earlier, depends on what assets you're looking at, but yeah, valuations are stretched. Maybe if they're making a broad market comment and they're measuring the S&P 500, it's now trading at over 19 times Wall Street's consensus estimates for next year, according to the fact set. So it ain't cheap. One legitimate reason for caution, if it's to be believed, is that, according to JP Morgan's research in this report they have, that by start of next year, all but the top 1% of the households in this country will have less liquidity than they've had since before the pandemic. So the COVID savings and enjoyment of spending all that free money is now exhausted. Of course, easing interest rates, lower inflation, higher wages can help address that trend if they occur. But since so much of this year's economic success was driven by the resiliency of the consumer, it's important to watch credit card balances, default rates, and other signs of the consumer potentially weakening, softening, petering out. Remember, I started off by reading the remarkably strong consumer confidence numbers today, but if those same consumers are running out of their discretionary cash, we need to be careful. That being said, it all ties back to this JP Morgan report, which goes on to say, quote, "We think the decline in inflation and economic activity that we forecast for 2024 will at some point make investors worry or perhaps even panic." Wow, ouch. Well, they're really making a pretty bold statement here. They're not mixing words. And wait till you see how different Goldman Sachs report is. But first, JP Morgan continues here, quote, "Overall, we are not positive on the performance of risk assets and the broader macro outlook over the next 12 months. The primary reason is the interest rate shock over the past 18 months that will negatively impact economic activity. Geopolitical developments are an additional challenge as they impact commodity prices, inflation, global trade in goods and services, and financial flows." And I'd say that geopolitical risks are to some degree always a risk, but yeah, I mean, today it's particularly bad. They mentioned even global trade. Well, even just shipping is becoming a concern now with the Suez Canal and shipments to the Red Sea being limited. But at the same time, though, a lot of that's already being absorbed to some level by the markets. It could get worse. But if we did have instead more benign resolutions to what we're currently seeing, that could aid risk assets versus what's being priced in today. But anyway, they go on to say here, quote, "At the same time, valuations of risky assets are expensive on average." Okay, on average, going on. Currently, we have high equity multiples, by various estimates, at least 3 turns of PE expensive, low levels of volatility, investor complacency and excess supply, and tight credit spreads. Bond yields of 5% plus present a high performance hurdle rate for other assets and strategies. For instance, in a very optimistic economic scenario, we can see equities outperforming bonds or cash by about 5%, while in a likely environment of declining growth or recession, they could underperform cash, meaning stocks could underperform cash, they're saying here. They say they could underperform cash by about 20%. Quote still, this is a catch-22 situation in which risk assets can't have a sustainable rally at this level of monetary restriction, and there will be likely no decisive easing unless risky assets correct or inflation declines due to, for example, weaker demand, thus hurting corporate profits. This would imply that we would need to first see some market declines and volatility during 2024 before easing of monetary conditions and therefore a more sustainable rally, end quote. So they don't think risk assets can rally in these conditions, which feels weird to say and put in print during this pretty strong rally we've had since the end of October. But I think they're making a reasonable point about the first quarter next year potentially being a bit hairy. Ultimately, I think 2024 can shape up to be decent for the full year, especially if you're value-oriented, maybe not focusing on the most crowded trades of previous times, so on. But I wouldn't be surprised to see at least the October lows revisited. And this establishes a good thesis for the start of next year, where the market has already priced in a lot of good. Priced in the Fed cutting rates, and the market being led by so few names, it sets the stage for a disappointing first half, opening the door for a large second half rally with broader, different leadership. That type of leadership we saw in this November and now December rally, where the balanced S&P is keeping up with it. Started off by exceeding it. Now they're basically neck and neck, the weighted S&P. But better valuations and squeezed returns on liquid assets may then see another period of money then flowing into risk assets. But calling the bottom and timing this, as always, is very difficult. Envision it now. Envision the volatility we're talking about, but don't leverage to that thesis. Don't sell out to, when I say be careful with your allocations to risk, don't overdo it in the other direction either, because you're trying to time this correction that may never come. That's a losing proposition. You have money that you don't expect to use for 3, 5, 10 years or more. Don't try to screw around for 3 months and try to time a correction. It ain't going to work. All right. Now to start comparing these two reports here. Okay, starting again with JP Morgan, they're going to succinct global outlook here. Quote, we expect global growth to slow to below potential due to the continued drag from tight monetary policy and rising yields and the fading of this year's significant positive shocks. Although headline inflation is expected to drop next year, we look for a shift in inflation psychology to keep global core inflation around 3%, largely because of continued upward pressure on labor costs and service prices. Central bank rhetoric will need to maintain a tightening bias. Okay. Well, then we will contrast that with Goldman Sachs' report to bring them in today. They say global inflation continues to plummet. Well, already, JP Morgan just said they think pressure on inflation is still going to be there, maintain a tightening bias. All right, Goldman Sachs, global inflation continues to plummet. Averaging across the broad group of economies that saw a large and unwanted post-COVID price surge, the G10, excluding Japan, plus the emerging market early hikers, we estimate that core inflation ran at a sequential annualized pace of 2.2% over the past 3 months and just 1.3% in November. We therefore now see earlier and more aggressive rate cuts from several major developed market central banks. We suggest that the core PCE inflation should hit that 2.5% threshold as soon as February 24 before falling further to 2.1% in May. This is still quoting Goldman Sachs. We now expect the first rate cut at the March 20th and 21st Federal Open Market Committee meeting. Right, so a huge juxtaposition there. And Goldman Sachs does sound a lot more like Jerome Powell's, and that they want to focusing squarely on PCE inflation. And Powell said as much as, hey, we don't expect to hit our target in the next 3 months and then cut rates. He said, we've hit that terminal rate. Inflation's coming down properly now. We expect to hit our target for inflation in 2025, but its course is set enough such that he's setting the course that they can start cutting. And that's kind of what Goldman is echoing here. JP Morgan says, we don't see inflation getting all the way back to 2%. And the, quote, final mile of getting inflation down will require a softer labor market. We expect the Fed doesn't take further strong action against inflation, but keeps policy modestly restrictive. Going on, they say, we believe the Fed is done raising interest rates and expects cuts to start. So they expect cuts also. They expect cuts to start in the third quarter of next year at a pace of 25 basis points per meeting, bringing the Fed funds rate down to 3.5% by mid-2025. Okay, so both of them at the end are not really that divergent as far as what the Fed's going to do. They both think the Fed's going to cut rates next year. Goldman sooner than later. JP Morgan kind of painting the picture for a rough start to the year, then cuts. And at some point, the market will start pricing in 2025. Just as in 2022, the market was pricing in the global macro scene in 2023. And what the market did this year, taking off, wasn't about what the underlying conditions were all year, but rather what's been building through the year and now looking forward to this. JP Morgan goes on for the U.S. outlook. Absent rapid Fed easing, we expect a more challenging macro backdrop for stocks next year. Equities are now richly valued with volatility near historic lows. By the way, this is me cutting in. Volatility near historic lows is bad. That's something that could lead to shocks to the upside. It's contradictory, but it's got nowhere to go but up, essentially. Going on with them, when geopolitical and political risks remain elevated, we expect another year of low to low single-digit earnings growth in developed markets with sharp revisions to unrealistic consensus growth estimates. And I've been talking about that a lot this year when Wall Street's average consensus estimate for according to the FactSet was that earnings growth, and it is versus some pretty low prints this year, so it's a low hurdle, but earnings growth rates in the low teens. So yeah, I wouldn't be surprised. And if we're trading at 19 times that estimate and we're only going to grow at 9%, which would still be pretty decent, the market's pretty expensive now. But we'll flip it back to Goldman Sachs, who says the combination of solid growth, sharply declining inflation, easier monetary policy, and lower long-term rates is exceptionally friendly for risk asset markets, and both our equity and credit strategists have therefore upgraded their return forecast materially. In fact, let me cut in here. Since this report was published initially, and I talked about it a few weeks ago, and I'll say it again, Goldman's actual ultimate target wasn't that high. They already raised their end-of-year 2024 S&P target in just the week since this was published. So that, it hits that target a little earlier. They just take the number higher. But where is I? So if we are right about the economic outlook, the recent easing in financial conditions has further to run, which would reinforce the positive growth impulse for 2024 and can result in further upward revisions to our already above consensus growth forecast. So admittedly, they are the more bullish of the pack. And lastly, now from them, Goldman Sachs, this is when they raised it in the last week, I believe it was, quote, we raise our year-end 2024 S&P 500 index target to 5,100, representing 8% upside from the current level when they published this. Decelerating inflation and Fed easing will keep real yields low and support a PE multiple greater than 19 times. Since late October, S&P has surged by 15% and the Russell 2000 has soared blah, 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 blah. Our prior year-end 2024 forecast assumed yields of 2.3% and a P of 18. Upside risks exist to or above consensus estimate of 5% growth. Improved macro outlook implies a more conductive environment. Anyway, so you can see, I'm not the point of the show was going to be, who do you trust? Well, the bottom line is that even if the very bullish analysis isn't offering it's just not offering a lot of upside from here. And their views of the fundamentals are strikingly different, but the spread in their conclusions is not that divergent. 5,100 from where we are now is not exactly pricing in the greatest return in market history. Goldman's rosy outlook was offering pretty modest upside until the market took off from the recent Fed comments and a more benign inflation data, and that will remain the underlying key for now. The markets are already now pricing in 3 cuts, according to Goldman, a cut as soon as the first quarter, and a soft landing. If inflation falls even faster than its recent track, then it allows forward earnings to be more valuable today, and it would allow further valuation expansion and upside to even maybe Goldman's estimates here. Of course, what would drive inflation down that hard, would probably also coincide with slower economic activity. However, it looks like the real risk may be to the downside, more than the chances that these estimates are just too conservative and it could be even better than what Goldman's painting here. Besides, as the investor continues to vacillate between panic and the fear of missing out, thinking that the world's coming to an end on October 31st to wanting to pile all into tech stocks by Christmas, I want to leave margin for error. If we do start the year with really favorable inflation numbers and some economic softness, especially reflected in employment numbers, and we do get a reversal in action from the Fed's higher for longer thesis, resulting in their first interest rate cut, then it may be clear that JP Morgan is off base here or too conservative. But don't leverage to that. It's just not usually productive to leverage to the most optimistic thesis. Keep some dry powder, but be particularly careful in the first quarter. Don't try to time it. Don't think that you're going to time a correction with assets that you want to own 5 years from now, because there's too much chance that you won't get to buy them back. But don't panic when you've already prepared psychologically for some volatility. The real difference now, different at least than it's been for over a decade, and this is maybe the most important lesson, is that unlike whatever was bothering you any given time over the last 10 years, the difference now is that you can get real return on fixed income. And when you take on additional equity risk, you should have some conviction there from a value point of view, a real expectation to exceed those annual fixed returns you'll get from a diverse fixed income portfolio, which now can be had with yields in the mid-single digits and maybe more comfortably can get the job done in many cases for your ultimate plan goals. All right, that's it for me today for this week's show. That's it for me for the end of 2023. I hope you found it helpful, that you've managed a happy and restful holiday season, and I hope that you'll return to us for a hopefully profitable 2024. Happy New Year's, everybody.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.